Jim Donald, Richard Vague, that's Michael Ashner coming out left, and then Ron Gilson. Thank you, gentlemen. Okay, here's our group. I think why don't we go one by one? Number one, each of these gentlemen is independent, and you can challenge their independence if you'd like, but I can tell you that we have no agreements, understandings, or otherwise with any of the directors other than they will serve on the board if they are elected, and we're paying the costs of this proxy contest. Their goal is to maximize shareholder value and serve all of the shareholders of the company. You compare them to the incumbent nominees, the people they're in some sense running against. The incumbent nominees lack senior operating experience. They own less than 0.05% of the company. Ultimately, we hold them accountable for the company's strategic mistakes. And 3 out of the 4 have been on the board for more than 10 years. You look at our executives, they have relevant experience in retail, credit cards, real estate. We've got Ron Gilson, one of the top corporate governance experts in the country. Pershing Square will be, we propose myself for this board. We own 7.8% of the company. And bottom line, the group offers fresh perspectives. Even if the nominees that have been on the board for 10 years are talented executives, at some point, Target's gotten the benefit of their expertise for the last 10 years, and having another executive of comparable expertise from a business background perspective, but relevant, but more specialized expertise in terms of what matters to Target, we think is a meaningful positive for the company. Let's talk about Jim, and we'll explain why we picked Jim. Food retailing is a critical strategic objective for the company. One way to improve traffic, obviously, is to have grocery in the mix. We quote Greg, "We continue to focus on food as a priority. We've nearly doubled our commitment to food over a 5 to 7 year time frame." Again, on a recent earnings call, we also continue to invest in our food offering in recognition of its importance in driving greater frequency, increasing guest loyalty, and making Target a preferred shopping destination. This is a repeat of the slide we saw before. Target's playing catch-up in this business. Same-store sales growth, big decline during a recession. Some people have said, well, when the world gets better, Target should do better. We think Target will do better when the world gets better, but we don't know how long we're going to be in a recession. We don't want to own stock in a company that does well only when times are good. Margins, an area that someone who comes from a grocery store background is obviously intensely focused on margins because of the thin margins in that business. If you look at the discretionary, non-discretionary mix, non-consumables, consumables, Walmart has a huge benefit, obviously, in a difficult economic time. Target is working to shift this balance. This is an expertise that Jim brings to the table. And we think there's a big opportunity. I'm going to let Jim introduce himself. Jim.
Thank you, Bill. Good morning. By way of introduction, my name is Jim Donald, and I've spent about 39 years in the retail business, 33 of those years in supermarket retail, and 6 years with Starbucks. I most recently was the CEO of Starbucks. Prior to that, Chairman and CEO of Pathmark Supermarkets, located right here in the New York metropolitan area. Prior to that, I ran the eastern region for Safeway, based in Atlanta, Maryland. Before that, I was with Walmart. Sam was still alive when we embarked on a supercenter strategy that goes back to, there was 4 in existence, and there were 4 supercenters, and we, by hook or crook, trial and error, managed to get that business started. Spent 16 years with Albertsons from the southeast all the way to the southwest, and then cut my teeth with Public Supermarkets as a kid growing up in Tampa, Florida.
Thank you. What we do here is we sort of benchmark each of our directors against one of the incumbent nominees. Mary Dillon is on the Target board. She's up for election, and I'm sure she's a very talented marketing executive. But she's a restaurant company marketing executive. She's not a grocery store operator. And importantly, Mary Minnick is on Target's board. So if Mary Dillon were not elected, Mary Minnick would still. She's one of the 8 directors. She's former chief marketing officer for Coca-Cola. I have to believe that her expertise is as relevant and as helpful, and there won't be a loss, in my opinion, if we lose in terms of Mary Dillon. Target is a customer, a meaningful customer of McDonald's. We compare Mary to Jim. Jim's got 30 years of experience in food retailing, former CEO of Pathmark. If you think about the ideal person to join this company's board would be someone who worked for the competitor and helped build their business when it was at an earlier stage. Jim is a completely independent director. Next one, we got Richard Vague. Doug Scovanner gave an interview to the Star Tribune a few days prior to our filing a 13D when there was a story in the press saying that Pershing was buying a stake and that one of the things we were focused on was credit cards. He said, "We have consistent performance. We're enjoying double-digit growth rates," Scovanner said. "No one else in the credit card arena has those attributes. For the life of me, I don't understand why those attributes in combination would cause anyone to want to get into an active mode of analyzing a sale." Now, I think Target's done a good job in building its credit card business, but it started its Target Visa business really at the tail end of the last recession in 2001. The company really had no experience operating the business during a recessionary period of time. And the true test of a credit card business is not how it does during one of the great credit expansions of all time, but how it does in a recession. I think the company had perhaps an overappreciation of its ability to underwrite in this kind of an environment, which made them resistant to the kind of transaction that we proposed. We worked very hard to convince them to exit this business, not the business in its entirety, but again, a partnership transaction would shift the credit risk and the funding risk to a third party. We think the company erred in the transaction it did with JP Morgan. In fact, while we were advocating to the company in the summer of 2007 to exit credit risk, the company made a significant decision to grant credit to a large percentage of their red card customers who are subprime customers, giving them $7,000, $8,000 credit lines. That led to a very significant increase, 20% increase in receivables, but those were not the customers that you wanted to attract, going into recession. This was very, very costly to the company. Some people have suggested the company really needed the boost to help boost sales, but we think a mistake that's unlikely to be made if there were a credit card industry executive on the board. We pointed out the profit decline in that business as a result of some errors. And let's look at this chart for a second. What we've done here is we've benchmarked Target against JP Morgan, B of A, American Express, Capital One, and Discovery Financial. And there's a wide gap, a couple hundred basis point performance gap over the last several years in terms of net write-offs. And then 2008, during the recession, you see a very significant increase in that spread. Again, the business was not recession tested, and we think the company perhaps had an overappreciation of their ability to run this business in a difficult time. If you look at bad debt expense, it tells the same story, but even a more dramatic, double the bad debt expense of Target's competitors. And it's just hard for a retailer with an $8 billion credit card business to compete with a JP Morgan or a Citi with a $100, $150, $200 billion portfolio. There are real economies of scale in this business. There are economies of underwriting. There's expertise you get running 30 different credit card programs. Richard Vague, why don't you introduce yourself?
Thank you, Bill, and thanks for the opportunity to be here. My name is Richard Vague, and I have almost 30 years' experience in the credit card industry. I was the co-founder in 1985 of First USA with John Tollison. We grew to be the largest Visa issuer in the industry. We were the #1 financial services stock on the New York Stock Exchange for the period that we were public. We had almost 60 million customers. We sold to Bank One in 1997. I was the co-founder in 2000 with Jim Stewart of Juniper Financial, again a credit card issuer, which grew to be a major force in providing partnership credit card services and was the fastest growing issuer in the business. We sold that business in 2004 to Barclays PLC of London. Both of those credit card entities specialized in providing partner services, co-branding, affinity type services. We literally had thousands of partners, including folks like Apple, Barnes & Noble, Southwest Airlines, and thousands of others, which gave us a particular sensitivity to how to structure a relationship with a partner that gave that partner the benefit of control of marketing, participation in credit and the like, let them have a vibrant program, but took the credit risk and the capital to ourselves. And we think that's very, very relevant here. Currently, I serve as chairman and CEO of a privately held energy company.
Thank you, Richard. We line up Richard Vague with Richard Kovacevic, one of the nominees up for election. In the case of Richard, we think of all the people on the board, he has the most expertise about credit cards because Wells Fargo has a credit card operation, and we ultimately hold him accountable for the decision not to do a partnering transaction. Now, notably, unlike